Hi, you guys. I'm Phil Town from Rule One Investing. Today, I want to talk to you about calculating the payback time on an investment to minimize your risk. So you guys have heard about the payback period before, right? Which is a valuation method used in private equity, buying private companies, right? Go buy a laundromat, to determine the amount of time it takes to recover the whole investment cost. Because, you buy a laundromat, they can't just go sell it real easily. That's not a public company. So we call that the payback time. So you want to get a payback time idea on how long it's going to take this laundromat to pay you off. So this is the length of time an investor needs to reach a break-even point from his original investment. And if you're not too familiar with this whole idea, I did write an entire book about it, which I call Payback Time, and was number one on the New York Times bestseller list for a while. Now, today we're going to dive into exactly what payback time is, and I'm going to help you calculate it. So let's get started. Okay, what's payback time? First, it is the payback period to get your money back when you buy a business. Now, this is a concept that's very useful to me when I've done private equity and venture capital. So you're not sure on those kinds of investments when you're likely to be able to get out. Markets are pretty illiquid. It's like buying a farm or buying a house. You're looking at something, you can't just immediately flip it on. Well, in most markets you can't. Sometimes you can. But generally you buy it as if you're going to have to hold it for a long time. And you basically want to get your money off the table. So the idea is if you own the whole company, this company is going to generate every year some free cash flow, at least if you bought the right kind of company. And what it does with this free cash flow is pay you back over time the amount of money that you put into the investment in the first place. That's what free cash flow is for. Free cash flow is the amount of money that's left over after you spend money on all your expenses and all of your capital expenditures to grow the company, all the things you're going to do to grow it. This is what you got left over. Now, some companies, they pay a dividend. Some companies buy back their stock. Some companies go out and try to buy other companies. But when we look at it from the point of view of a private equity investor, we just want to know how many years of this cash flow is it going to take before I've got my money off the table. So here's an example. Let's say you have your own little mom and pop laundromat. At the end of the year, there's some free cash flow left over in the register, and you can put it in your pocket. Now, if you can do that every year and you add that money up over the next 8 years, it turns out you'd pay for the company in 8 years. And that's very good. Now, what Wall Street's willing to pay for a company out in a public company is 16 times the earnings as a fair multiple, right? As a fair multiple. But we're looking at a little different kind of numbers. We want to know when is our cash coming back, not that sort of amorphous idea of earnings, which could be not real. So if we can get our cash and our money paid back to us, not out of earnings, but out of cash in 8 years, that's very good. And that's what payback time is calculating. Here's how you calculate it. You use your cash flow. Remember, this is not a number you find on the financial statement, but you take the operating cash flow off the financial statement and you subtract the line that says capital expenditures. What you have left is known as free cash flow. Now, to make things simple for all of us rulers and myself, I built a little toolbox, spent, to date about $4 million on this thing, something that I invented and I use all the time to research stocks that'll help you calculate this kind of stuff because not everybody looks at things this way. So this is one of the items that we cover in my workshop. And if you haven't been to it, you're going to miss out. You should go. You're just going to miss out on a lot of learning and a lot of great investing tips and tools just like this. But that is exactly how we calculate the payback period to see how long it'll take you to recover the cost of your investment. It's really simple. You take the free cash flow this year, you add a growth factor to it. Maybe you're growing at 4% or 2% every year. You can increase your free cash flow by a couple percent. You add that percentage in, and then you get your second year free cash flow. And you just keep doing that for 8 years. Now, total all of those cash flows, and that should be the most you should pay for this company. That's a great way to do it without worrying about, I just wonder how big these guys are going to get. Just do it where you get your money off the table and you don't have to worry about it anymore. So join me at my next virtual workshop where we talk about all this stuff. You get access to this incredible toolbox. It's going to help you determine the value of a company. Lots of different ways, 3 different ways, in fact. and payback time is one of them, in order to determine what you want to pay for it. Now, I'd love to hear from you guys. Would you be able to minimize your risk using payback time by getting your money off the table? Yeah, let's take a look. Leave a comment below with your answer. I'll be sure to follow up with you, and thanks for watching. Now go play. Guys, if you enjoyed this video and you feel it was valuable in teaching you more about calculating the payback time to minimize your risk by getting your money off the table, just hit the like button and share the video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen for a free gift. And thanks for watching.